here's something that might make you raise an eyebrow. What if the investments, often seen as the steady eddies, the value stocks,
Hmm.
those companies that look cheap based on their fundamentals actually carry more risk than those high-flying growth stocks? The ones everyone thinks are, well, the dangerous ones.
Yeah, it seems counterintuitive, right?
Totally.
And that's exactly where our deep dive begins today. For a long, long time, the financial world has seen this interesting thing called the value premium,
Right.
where, historically, value stocks tend to give you better returns than growth stocks. Over the long haul, anyway.
Yeah, that outperformance is pretty well documented. But today, we're not just talking about who wins the return race, are we?
No, not at all.
We're digging into some really fascinating research that honestly makes you reconsider the risk involved, in these two very different ways of investing.
We're tackling it head on. Is value riskier than growth?
Oh.
And this isn't just some abstract academic chat. For you, the listener, getting a handle on the true risk profile here. Value versus growth.
Hmm.
And especially how that risk can shift depending on what's happening.
Yeah, the economy.
In the broader economy, that can be incredibly valuable. It helps you shape your decisions, make sense of all the market swings.
Precisely. And our main guide for this whole exploration is this really thought-provoking study. It's from 2005, Journal of Financial Economics by Petkova and Zhang.
Right.
And they took a really deep dive into how the risk tied to value and growth stocks actually changes over time.
It's not static.
No. So our mission today really is to unpack what they found, to see if the evidence points towards value stocks actually being riskier than growth, especially when you factor in how that risk kind of ebbs and flows with the economic tides.
Okay, so let's start with the common wisdom, the intuition.
Yeah.
Most people, and frankly, a lot of early financial thinking, kind of ran on the principle that higher returns usually mean higher risk. It's a pretty,
Yeah.
deeply ingrained idea.
It just feels logical, doesn't it? Like,
Yeah.
you step out further on the risk ladder.
Mm-hmm.
So you expect, or demand maybe, a bigger potential payoff for taking that extra leap.
Exactly. More potential reward means more potential downside. And for a while, maybe the higher returns of value stocks seemed to fit that picture for some people. They thought, that's why they pay more.
But then things got complicated.
Yeah, but then this wave of really influential research hit. Back in the late 80s, early 90s, you had names like Lakonishuk, Schleifer, Vishny, DeBont, and Thaler, Chopra, Lakonishuk, Ritter.
Big names.
Big names. And they looked at how the market actually performed, the realized returns. And their work suggested, well, maybe value stocks aren't riskier at all. Some even hinted they might be less risky, particularly when the economy hit a rough patch.
Okay, so less risky in bad times. That flips the script.
Totally. And that led to these theories about market mispricing, the idea that maybe investors were just unfairly undervaluing these less glamorous companies, even if they were fundamentally sound.
So these earlier studies, they used actual market performance, what happened yesterday or last year, as their benchmark for good times and bad times.
Right.
And they basically argued, look, value stocks hold up, maybe even do better when the market tanks. So where's this supposed extra risk that justifies the higher returns?
Exactly. That was the argument. Their whole focus was on realized market returns, what actually happened.
Okay.
Now, this is where Petkova and Zhang's research takes a really interesting turn, a different path.
How so?
They shifted the focus. They started looking hard at this idea of time-varying risk.
Time-varying risk. Okay, let's unpack that a bit. It kind of makes intuitive sense, right? Risk isn't just a flat number.
No, definitely not.
Like driving on an icy road versus a dry one, the risk changes with the conditions, obviously. So how did they apply that to value and growth stocks?
Well, their key finding was that this time-varying risk seems to play a pretty significant role in understanding that value premium we mentioned earlier. But the really crucial part is how the risk changes. They found that the betas of value stocks.
And beta is, just quickly for everyone.
Oh, right. Betas is basically a measure of how much a stock's price tends to move up or down compared to the overall market. A beta of 1 means it moves with the market, higher means more volatile, lower means less.
Got it. So value stock betas.
They tend to move in the same direction as the expected market risk premium.
Hold on, expected market risk premium. How's that different from just looking back at what the market actually did, like those earlier studies?
That's a really, really important distinction.
Yeah.
Petkova and Zhang looked at several forward-looking economic indicators.
Like what?
Things like the market's dividend yield, the default spread. That's the difference in yield between riskier corporate bonds and safer government bonds.
Okay.
The term spread, so the yield difference between long-term and short-term government bonds and the short-term interest rate itself. These kinds of variables have historically been used to, well, predict how much extra return investors are likely going to demand for taking on market risk.
Ah, I see. So instead of looking in the rearview mirror at the realized returns to say, okay, this was a good time or a bad time,
Right.
they were looking at the economic dashboard, kind of, at what the market seemed to be anticipating in terms of needing more compensation for risk going forward.
Precisely. It's a forward-looking perspective, a forecast in a way.
That's a clever shift. So what did they find using that approach?
Well, they discovered that the betas of value stocks tend to climb higher when these indicators suggest a higher expected market risk premium is coming.
Which usually signals tougher economic times ahead.
Right. Generally, yes.
Yeah.
That's the interpretation.
Mm.
And conversely, the betas of growth stocks tended to move the other way. They got lower when a higher market risk premium was expected.
Interesting.
The researchers themselves said this relationship between the betas and the expected premium goes in the right direction in explaining the value premium.
Okay, so let me try to rephrase. When the economic warning lights were flashing, signaling higher expected risk, value stocks actually became more sensitive to the market's ups and downs, which sounds a lot like they carry more risk during those potentially challenging times.
That's the idea. It aligns with them carrying more risk, specifically systematic risk, in those periods.
But why would those earlier studies, the ones looking at actual market performance, have missed this? They saw value as safer in downturns.
That's a key point Petkova and Zhang really dig into. They argue that just using the realized market return, what actually happened day to day or month to month, can be, well, noisy and potentially misleading about the true underlying economic state.
How so?
Well, think about it. A single day of really bad market news doesn't automatically mean we're heading for a deep recession, right?
Right, could be a blip.
Or you could have a strong market day even if the underlying economic fundamentals are actually pretty shaky. People might be optimistic for a moment. As the authors put it, and this is a great quote, what previous studies classify as good states ex post tend to be bad states ex ante, and vice versa in terms of business cycles.
Okay, that makes a ton of sense. Looking back might not capture the feeling or the expectation at the time. So focusing on the expected risk premium gave them maybe a more accurate read on the underlying economic climate investors were facing.
That's the argument, a more forward-looking read. Now, they also used something called a sorting procedure. What was that about?
Yeah, tell us about that.
So the sorting procedure was basically a way for them to compare these conditional betas, the betas under different conditions for value and growth stocks. They defined these conditions based on the level of that expected market risk premium.
Okay.
They essentially divided their historical data into 4 buckets, representing different economic states. Peak, which had the lowest expected premium, maybe suggesting an overheated market.
Right.
Expansion, with a below-average expected premium. Recession, with an above-average expected premium. And trough, which had the highest expected premium, signaling the most stressed economic conditions.
So sorting by the level of anticipated risk, and what popped out when they did that?
For the standard value minus growth portfolio, you often see it called HML.
High minus low book to market.
Exactly. High book-to-market value stocks minus low book-to-market growth stocks. For that HML portfolio, they found its rolling beta. That's a beta calculated over a moving window, like 60 months.
Okay.
That rolling beta was indeed lower in those peak states, the good times based on expectations,
Yeah.
and significantly higher in the trough states, the really stressed times.
Ah, so that supports the idea of countercyclical risk for value.
Yeah.
Riskier when the expected outlook is worst.
Exactly, it lines up. But they also look at HMLs, that's the same value premium idea, but specifically among small cap stocks.
Right, the little guys.
And there, the results were, well, a bit more mixed, a bit fuzzier. In the full sample period, the HML's betas were generally negative across all those economic states.
Negative betas, so moving opposite the market.
Yeah, which suggests maybe the value effect, or at least its risk profile, plays out differently for smaller companies compared to the broader market measure. It adds a wrinkle.
Okay, so the main HML finding supports the time-varying risk idea, but it's not perfectly clean across the board, especially with small stocks. That's an important nuance. Now, you also mentioned beta premium sensitivity. That sounds technical.
It is a bit, but it's important. It comes from what's called the conditional capital asset pricing model, or conditional CAPM.
Okay.
Now, the basic CAPM just says a stock's expected return depends on its beta with the market. Simple enough.
Right.
The conditional CAPM takes it a step further. It says, hey, That beta itself might change depending on economic conditions.
Which is what we've been talking about.
Exactly. And beta premium sensitivity specifically measures how sensitive a stock's beta is to changes in that expected market risk premium we discussed.
So it's like measuring how much the beta wobbles as the economic forecast changes.
That's a great way to put it. It gauges the instability of a stock's market risk across the business cycle.
Okay. And why is that important for figuring out risk and return?
Well, the thinking goes like this. Stocks with a positive beta premium sensitivity.
Meaning their beta goes up when the expected risk premium goes up.
Correct. Those stocks become riskier precisely during recessions, or expected recessions times, when investors are generally much more risk-averse and demand a higher payoff for bearing any risk.
Ah, okay. So if a stock gets riskier just when you least want risk.
Then you'd expect it to offer a higher average return over the long run to compensate you for bearing that extra risk during the really bad potential times.
Makes sense. So what did Petkova and Zhang find for the beta premium sensitivity of value versus growth? Did it match the theory?
For HML, the main value minus growth factor, it did. Their findings were quite revealing. They saw a positive beta premium sensitivity.
How is that?
Yes, using both the rolling beta calculations and also using more statistically derived fitted betas. This gives even more weight to the idea that value stocks do carry higher risk during those times when investors are most worried, those potential downturns signaled by a high expected market risk premium.
So more evidence pointing the same way.
Pretty much, however,
Yeah.
and there's always a however, it seems.
Especially with small caps.
You guessed it. Once again, the results for HMLs, the small cap value premium, were more complex. It showed a small positive sensitivity using rolling betas, but actually a negative sensitivity with the fitted betas in the full sample.
Negative. So small value stocks getting less sensitive to the market when the expected risk premium rose, according to that measure.
According to the fitted beta measure, yes. So again, it signals that the story for small cap value might be different, or at least more complicated, than for large cap value or the overall value factor.
It really seems like size matters here, or interacts with the value effect in complex ways. Now, the study didn't just look at one long period, did it? They broke it down.
That's right, and that's where we see some interesting variations pop up. They looked at the full historical sample, going way back. Then they chopped off the Great Depression period to see if that massive event skewed things.
Good idea.
And they also focused specifically on the more modern post-Compostat era, which starts around 1963 when better company data became available.
Okay. And did the evidence for this time-varying risk hold up consistently across all those periods?
Not entirely. Actually differed somewhat. The strength of the evidence for time-varying risk in this beta premium sensitivity wasn't uniform.
Interesting. What happened when they took out the Great Depression?
Excluding the Depression had a noticeable effect, especially on those beta premium sensitivities for small growth firms.
Small growth, okay.
Yeah. The authors kind of suggest that the unique, really severe financial chaos of that era, mass bank failures, widespread defaults.
Unprecedented stuff.
Exactly. That might have hit these smaller, maybe more financially fragile growth companies especially hard, potentially messing with the results for that specific period.
That makes sense. An extreme outlier event like the Depression could definitely distort things. What about that later period, the post-Compostat one, from 63 onwards?
In that period, 1963 to 2001, the evidence supporting this strong time-varying risk defined by the expected premium was generally weaker.
Weaker? Why might that be?
Well, Petkova and Zhang offer a couple of potential reasons. One idea they float is maybe increased investor overreaction, especially to things like company earnings news, in more recent decades might have just added more noise, obscuring the relationship.
Okay, more noise. Plausible.
Another factor could simply be the nature of that period itself. The post-Compostat era, up to 2001 anyway, was actually relatively unique in its economic stability compared to earlier history. It just had fewer significant recessions.
Fewer downturns.
Yeah. They point out that if you have fewer deep economic troughs in your sample period, then you have fewer chances to actually observe this potential spike in value stock risk that's supposed to happen during those really adverse conditions.
Exactly. So the specific time frame you look at can really color the findings in financial research. It matters a lot.
Definitely highlights that context is key. Okay, so they found evidence that time-varying risk matters. It points in the right direction, especially for HML outside the small cap world. But was that the end of the story? Not quite. Despite finding this evidence, Petkova and Zhang reached another really significant conclusion, a second major finding.
Okay, what was that?
that this time-varying risk alone, even when you model it using their conditional CAPM framework, it's not enough to fully explain the size of the value premium that we've historically seen.
Not enough. So it helps explain some of it, but not all.
Precisely. Even after they accounted for these betas fluctuating with the expected market risk premium, the alphas,
Which are the excess returns you can't explain by the risk model.
right, the unexplained bit, those alphas for the value minus growth strategies like HML remained largely positive and statistically significant in their tests.
Wow. So, okay, let me get this straight. Even though value stocks seem to get riskier when anticipated economic conditions worsen,
Yes.
that increase in risk still doesn't fully account for why they tend to deliver higher average returns over the long haul.
That's the bottom line from their analysis. The time-varying risk is there, it goes the right way, but it's just not powerful enough within this model to explain the whole premium.
That sounds like a pretty significant takeaway. Leaves a big chunk unexplained.
It is, and it actually lines up with other research around that time, like work by Llewellyn and Nagel, which also cast doubt on how well the conditional CAPM could really explain various asset pricing puzzles, including the value premium.
So this brings us right back to those earlier behavioral finance arguments, doesn't it?
Yeah.
The ones that said value isn't riskier, maybe even safer, because it seemed to hold up better during actual market downturns.
It does.
How do Petkova and Zhang square their findings with that view? Because it sounds like a direct contradiction.
It does sound like it, but this is where their research offers a really crucial clarification. It hinges on that definition of bad times.
Okay.
Remember, those earlier studies, like Lekanishuk and colleagues, they defined bad times based on realized market returns, what actually happened in the market after the fact.
Right. Looking backward.
Looking backward. Petkova and Zhang argue that this definition might not line up well with periods of high expected risk, what investors were anticipating or fearing before a potential downturn actually hit.
Ah, the timing difference again. Expectation versus reality.
Exactly. And their analysis really highlights this. They run market regressions conditioned on both low and high expected market risk premiums. And what they show is when you define bad times by a high expected premium,
Okay.
the beta of HML, that main value minus growth portfolio, is significantly higher. It directly contradicts the findings based on realized returns, where the HML beta often look lower in market downturns.
So it completely flips depending on whether you define bad times by looking forward with expectations or backward with realized outcomes.
That's the critical distinction they draw. That shift in perspective from realized to expected risk seems absolutely crucial to understanding their results and why they differ from some earlier work.
Fascinating. Now, is there any kind of theoretical story for why value stocks might behave this way, why they'd get riskier when the economic outlook dims?
Yes, they do point to a potential explanation. It comes from a rational, economics-based model proposed by Liu Zhang in a separate paper, also from 2005.
Okay, what's the core idea?
It centers on something called the costly reversibility of capital.
Costly reversibility.
Yeah.
Meaning it's hard to undo investment.
Sort of, yeah.
Yeah.
The basic argument is that in tough economic times, value firms, which often tend to be maybe less productive, have more capital already sunk into existing assets, old plants, machinery.
Right, established industries sometimes.
Exactly. They struggle more to scale down their operations when demand falls. It's costly and difficult for them to shrink. This lack of flexibility makes them more sensitive, more vulnerable to economic downturns.
Okay. And growth firms?
Growth firms, on the other hand, often rely more on future growth opportunities. They might have less physical capital already invested. So the argument goes they might have more flexibility to adjust, maybe delay expansion plans when things look bad.
So it's about operational flexibility during downturns.
That's the core of Zhang's model, yes. This difference in how easily they can adapt to changing economic weather contributes to that higher beta, that higher sensitivity of value stocks in anticipated bad times.
That's a really interesting theoretical underpinning for their empirical findings. It gives a why. Okay, so let's try and bring our main discussion together here to sort of wrap up the core findings. What are the key insights about the risk of value versus growth that this Petkova and Zhang research really brings to light?
Well, I think the big picture is that the relationship is just more complex, more nuanced than a simple value is safe or value is risky statement.
Definitely not black and white.
No. Time-varying risk seems to be a real factor. Value stocks do tend to show greater sensitivity to the overall market, a higher beta, during periods when that expected market risk premium is high.
So when the economic forecast looks gloomy.
Exactly. When the outlook appears more uncertain or negative.
Hmm.
However, and this is the second big piece, that increased risk on its own doesn't seem to be enough to fully explain the historical size of the value premium.
Right, the alpha is still there.
The alpha is still there in their tests, which suggests that other factors must also be at play, whether that's other kinds of risk not captured by this model, or maybe those behavioral biases and mispricings that the earlier studies pointed to, or maybe a combination.
Okay, let's bring this right back to you, the listener. Thinking about your own investments, what's the most important takeaway from this whole deep dive into Pitkova and Zhang's work?
I think the key insight is that the relative riskiness of value and growth isn't fixed. It's dynamic. While maybe earlier thinking, based on looking backward at market crashes, might have suggested value was the safer harbor.
Yeah.
This research really highlights that value stocks tend to exhibit higher risk, higher market sensitivity in periods when the future economic outlook looks challenging, when that expected market risk premium is elevated, basically when investors perceive potential bad times ahead.
So here's something to chew on then. Does this updated understanding, this idea that value stock risk can fluctuate and peak when the economic climate feels uncertain, does that change how you should think about your own asset allocation? Does the thought that value might actually be riskier just when things feel shaky make you rethink your mix? Or does that still unexplained chunk of the value premium, that persistent alpha, suggest that maybe there are still other forces, perhaps behavioral ones, that make value attractive despite this time-varying risk?
It's definitely a question worth pondering for your own situation. There's no single right answer.
For sure.
And we'd really encourage you, if this interests you, to maybe delve a bit deeper. Look into the research we talked about, maybe explore other perspectives on asset pricing, behavioral finance.
Yeah.
Just think critically about how these more nuanced understandings might inform your own investment approach.
Absolutely. Ultimately, wrestling with this kind of evidence, especially when it challenges the easy answers or the conventional wisdom, that's how you build a more informed, more sophisticated view of how markets work.
Well said.
And that's exactly what we aim to do with this deep dive today, give you a clearer, more evidence-based perspective on a really complex and frankly still debated topic in finance.